Joining us now to discuss the latest on the international economic scene is Jeremy Thorpe. He's the Chief Economist at PwC. Jeremy, thanks so much for your time. First of all, let's start with the reaction on the markets to the trade war. What do you make of it? And in Australian terms, what damage can it do to our economy?
To some degree, I think the markets have overreacted. You kind of expect that, and you expect the second and third day maybe a bit more reasoned thought. Clearly, the Australian dollar falling significantly was to be expected. That obviously creates some issues. And we do see that companies that are exposed to China or to global growth are going to be impacted. But we need to look beyond the first flush. I think most projections, and we've seen one of the ratings agencies overnight came out and have said that Australian GDP might fall by 0.1% off the back of the new tariffs. We need to put some context around the Trump response or the US response to raise tariffs. But equally, we are delving into a period of greater risk. I think we've seen China respond in a way that we hadn't seen over the past year, where it's a more belligerent response to let the Chinese currency devalue, and that's created the second round that we've had this week around the criticisms of currency manipulation. So I think people are nervous, markets are nervous, but equally we need to kind of understand that from an Australian perspective, the US tariffs and US intervention might actually create some new opportunities. Dragging global growth down is not going to be good, but really we need to temper it with a more moderate view, I believe.
And when it comes to the Australian perspective, one of the big questions, especially here in Canberra, is what this impact it will have on the federal budget, especially when we're so reliant on steel prices to get that promised surplus from the government. What do you see as being the biggest impact for the federal budget?
We talk about iron ore, we talk about coal. I think we also need to be talking about gold. We've had remarkably resilient and above target prices for our natural resources into China. Even with a small, or not a small, even with the hiccup that we've got at the moment, the natural inclination that we've seen out of the Chinese government is to try and prop up its domestic economy through expansion of infrastructure, and that's actually had beneficial flow-ons into Australian prices as well. We've been a bit lucky that some of the supply constraints, particularly out of Brazil in the last couple of months, have meant that prices have been even higher than we might have expected. So I think the issue around prices for iron ore is going to be obviously very significant. And we're effectively forecasting that the budget surplus is going to be above what the federal government has already foreshadowed because of those high iron ore, coal and gold prices. So we will take a hit to the budget, but I don't think it, at the moment, puts it at risk of falling into a deficit situation. The domestic economy is really going to be the key issue here. We've got soft growth, and as we've already seen, the Reserve Bank downgrading future growth, but still nowhere near a recession. We've still got strong employment growth. So I don't think that at the moment, and everything's tempered, everything can change quickly in this space, I don't think we're seeing this as a significant shock to the Australian budget.